Hello everyone, this is Harshit, and with me I have Kartikeya, and we welcome you to the fifth episode of MarkUp Unscripted. Here you will get a peek into the frank banter from the world of marketing, and as per your demand, today we will also have a peek into the world of finance. So today we have our guest with us, Ms. Stuti Rajuka from Ticker by Finology. And for those of you who don't know yet what Ticker is, it is your perfect personal assistant for all your equity research and personal investment needs. So we welcome you, Stuti, on our podcast.
Hi, thank you. Thank you so much.
Yeah. So Stuti is with us to discuss the mental biasness one faces in the share market. With the popularity of scam 1992, I'm sure everyone would be hearing about the share market whenever they hear the fancy intro music that plays on their mind, and we picturize Pratik Gandhi. So, but before all that, before we move into all that mental biasness, why should one put their hard-earned money in the share market? If you can throw some light on that.
I must say, I'm a fan of this web series too. Well, the share market has witnessed many white collar frauds, but it is not all about that. The reason you should invest in the share market is if you want to do business. Whenever one thinks of starting a business, the biggest fear is that one doesn't know how to manage money. Also, everybody does not have so much money and time to invest and nurture a business. So even with just rupees 500, you can purchase shares of a company and become the owner. You do not need to hire experts or give time.
Interesting. And we've often heard stories of people who lost their life savings in the share market. So, what's your take on that?
Yes, many people view share market as betting and gambling. This is because most of them confuse trading with investing. Trading is when you infuse money in the market for short term. Here, your objective is to earn from daily price fluctuations, but investing is all about creating value. It means you have done research about the company, and most importantly, you believe in the business idea of the company. Suppose you are purchasing a share on the notion that the share price of, say, company A will rise from 600 to 650 tomorrow or by the end of the trading day. It is simply a bet. There are chances that you might lose money. But when you invest, you want to earn from the growth of the economy. You see, in 2010, the gold price was 18,500 per 10 grams, I guess, and now it is around 50,000. So when you invest, the chances of profit are very high.
Yeah, definitely, Stuti. So I also remember a time when I also did not know the difference between investment and trading, and I found out. So very well, we got to know that it is the investing that we have to do if we want to earn profits from the share market. So you talked about research and believing in the idea of business before investing. So from where could we get all that information about the company? What do you do?
There are a lot of sources from where we can get this information. Just like little knowledge is a dangerous thing, similarly, too much information also creates confusion. I would say the very first hand information about any company is in its annual reports, but annual reports are too lengthy to read. One requires time and patience to interpret it properly. So there is some information. We want a source in which we can get all the information in one click. I'm very glad to tell you that Finology has made this possible by launching Ticker. It is the ultimate stock research platform where you can get to know a company from start to date within few minutes. So, be it company history or financial ratios, performance charts, everything, even annual reports and credit reports are also linked for your convenience. So, I think it is a good start for beginners.
So, to all the beginners who want to begin their investment journey, Ticker is your starting point. And also to all the current investors who are facing difficulties in collating data, just visit phenology.ticker.in. But most people think that I will start investing when I earn more money or I have so many expenses that there is no capital left to invest. So, do you think it's a matter of less money or just procrastination?
Well, there are a lot of talks going around mental health in these days, but nobody really talks about mental wealth. Most of
True.
the people are ruled by the fear of losing money. They think that earning more money is going to solve all their problems, because most of them, particularly the middle class, are guided by immediate validation. Like if Sharma ji has bought Baleno, then you want to buy Honda City. So people are so guided by external validation that they do not give a thought whether they can even afford a car or not.
About that example from Sharma ji, so should you mean that we should not purchase a car?
No, I'm not at all saying that. If I ask what is a car, an asset or liability?
Yeah, definitely it will be an asset, Stuti.
Yes, this is how we have been taught in accounts. Cars are an asset, but only when you have not taken any loan to buy the same. If you have purchased a car on loan, you are paying EMI every month. This is additional obligation you have taken when you have bought the car for just for the sake of validation. So how come cars are an asset for you? It is a liability. Because of your car, there is a fixed cash outflow every month till the time you repay the loan. And as you earn more money, you will fall prey to more such validation. Therefore, earning more money is not the solution, but financial literacy is. Financial literacy is spending your money, which actually proves to be an asset for you. Like when you invest in shares, it gets you dividend, and if the share price increases, you gain in the form of capital appreciation. So this is your real asset, and this postponing your investment journey has nothing to do with having less money. There could be a case where a person earning 10,000 can save 2,000, but a person earning 50,000 is left with zero savings because of EMIs. So you have to save for your investments rather than purchasing liabilities. Also, sometimes we treat the same amount of money differently because of the emotional value attached. For example, 10,000 earned from salary is more dear to me than 10,000 earned from lottery. So suppose you have bought a car by taking a loan of 10 lakhs and paying interest at the rate, say 12%. But you have 10 lakhs already in your fixed deposit where you are getting an interest of 7%. So you have shifted to a high cost of capital because your sentiments are attached to FD.
So one can become an emotional fool in spending money. So what are the mental biases that an investor faces after buying a share? Could you throw some light on that?
Yeah, definitely. The most common bias is do something bias. It is the lack of ability of investors to sit idle. Investors need to be updated about each and every news, of course, but need not act on each of them. It is commonly seen that when an investor's portfolio is not performing well, it gets very difficult for him to sit idle and wait for the market to recover. The most recent example that I recollect is when Elon Musk tweeted to use Signal. What he meant was the messaging app Signal because of the privacy concerns in WhatsApp, but people misunderstood the same as a company with the name of Signal Advance Inc., which is actually a medical device firm and has nothing to do with Signal messaging app. This misunderstanding drove the share price of the company by around 11,000% in just 3 days.
Yeah, Stuti, this was something that I also closely followed. Well, that does say that there's so much misinformation in the market.
Absolutely.
So, what happened when this misinformation was cleared? If you can throw some light on that also.
Yeah, as expected, people started selling their shares like there is no tomorrow. Similar incidents were also seen in India when Tanishq fell into an advertisement controversy in October. The share price of Titan company fell around 3.4%, although nothing has changed in company's fundamentals. So after they removed the ad, the share price recovered and it is around 1500 today, I guess. So sometimes a marketing strategy gone wrong can affect the share price of the company also. Although these are very short-term price fluctuations and do not have much impact in the long term.
Very interesting. So what can an investor do to not get influenced by these mental biases you speak of?
Yeah, the very first thing is when the markets are falling,
Mm-hmm.
investors need to maintain their patience and wait for the market to recover. You know,
Right.
it is like a sale that they need to invest when the market is bearish. Investors need to focus on the big picture. Instead of focusing on the short term price changes, their focus should be on wealth creation.
Yes.
There is a saying that goes in the stock market that be fearful when others are greedy and be greedy when others are fearful.
Right.
Yeah, Stuti, so yeah, we do know that, not every, we should not react to every news and focus. But I have a mental dilemma if you can help me with that. What should I do when I see a company that has performed in a past, and if I am buying that share based on that performance, so am I mentally biased?
Yes, Harshit, you are. This is called anchoring. Anchoring is using historical information as a base to make investment decisions. There is nothing wrong in analyzing a company's past performance, but your decision cannot be only based on that. Uh, I recollect there was an experiment that I read about which was carried out in 1974 and it was called Wheel of Fortune. So, what happened is that participants were shown numbers generated by the wheel and then asked what percentage of African nations were members of the UN. You would be surprised to know the answers given by the participants were around the random numbers shown to them by the Wheel of Fortune. So, this is anchoring in the context of share market, as you said, making current investment decisions based on the past information. Another example of anchoring could be when an investor buys a share, he mentally fixes a price to sell instead of considering the valuation of the company. Maybe it is more profitable to hold the share further. Suppose an investor finds a share overvalued at, say, rupees 100. He fixes 80 as the price at which he will purchase the shares. But after he purchased the share price falls to 50. So here the investor was biased on some random number that is 80 instead of actually evaluating the company that there is a possibility then that share price can still fall beyond 80. So to prevent oneself from anchoring bias, one has to keep a close look at the valuation of the share.
Yeah, well, that was really informative, Stuti. And with that, we have come to an end of this episode. And guys, do try the ticker app yourself and share your experience.
Thank
Also, to remind you all, as we all heard, Finology Ticker is your ultimate equity research partner that will teach you the tricks of the trade. And now they're also giving you a chance to win free Ticker Plus subscription worth rupees 2000. So visit learn.finology.in/test and register for the contest. It's open to everyone till 6 p.m. tomorrow evening. So participate soon. And just for a friendly reminder, Eureka Effect is beginning from tomorrow, 25th January. Register fast if you haven't, and we assure you that this time it's even more fun than ever before. And to keep up with the latest updates about the world of marketing, subscribe to MarkUp Unscripted on YouTube as well as Spotify. With that, we would like to sign off.